Welcome to the Explainer. Today we're breaking down a blockbuster quarter from Tapestry. Their fiscal 2026 Q2 results didn't just meet the mark, they completely blew past it, sending a real signal through the luxury goods space. So let's just dive right in with the only number you really need to know to get the market's verdict. The stock surged over 10% on the day of the announcement. Now, in this market, a jump like that is huge. It tells you this wasn't just a good quarter, it signals a real shift in how investors are thinking about this company. So let's unpack what drove that rally. So what exactly caused that reaction? Well, it was a decisive beat right across the board. This wasn't just squeaking by. Tapestry didn't just clear the bar, they absolutely shattered it. It really feels like a new chapter for their performance. Just look at these headline numbers. On the top line, revenue came in at $2.5 billion. That smashed the consensus estimate by almost $200 million. And then you look at the bottom line, earnings per share of $2.68, a full 48 cents above what analysts were calling for. I mean, these aren't just beats, they're total blowouts. And this chart really visualizes that earnings power. You can see it right there. That $2.68 per share in GAAP earnings was nearly 22% higher than what Wall Street had predicted. I mean, that is just a massive outperformance, and it really shows you the kind of earnings power the company is flexing right now. So what's behind it all? Well, the CEO, Joanne Krivozieret, framed this quarter as proof that their long-term Amplify strategy is not just working, but accelerating. She used the word compounding, which is key. It suggests that this isn't a one-time thing, but that the momentum is actually building. Okay, so let's move on and see how this all builds by looking inside the numbers at the brand level. This is where the story gets really interesting. You know, the story of this quarter is really a tale of two brands. First, you've got Coach, which is just firing on all cylinders, acting as a powerful growth engine. Revenue was up 25%. But then you have Kate Spade, which is in the middle of this really intentional, strategic reset. They're pulling back on promotions and even reducing handbag styles to re-energize the brand for the long haul. And this number brilliantly illustrates the impact on profitability. Even with that intentional sales pullback at Kate Spade, the company's overall non-GAAP operating margin expanded by a massive 390 basis points year over year. That's a huge deal. It shows they're getting way more efficient and turning more of their sales into actual profit. Let's just double-click on Coach for a second, because the performance was simply exceptional. Revenue surged 25%. They brought in 2.9 million new customers, a lot of them from that crucial Gen Z demographic. And this wasn't just one region, it was everywhere. North America, Greater China, Europe all saw huge double-digit growth. Just an absolute powerhouse. Now, a quarter like this, it's no surprise it gave management the confidence to significantly raise their outlook for the rest of the year. And for investors, this is exactly what you want to hear. It signals that they believe this isn't just a flash in the pan. The CFO's commentary during the earnings call really captured this bullish sentiment perfectly. He described the company as a powerful machine that has found a new gear of growth. That kind of language tells you they feel they've hit an inflection point where strong growth and operational discipline are working together. And they translated that confidence directly into a significant guidance raise. They're projecting higher revenue, much higher earnings per share. We're talking an 85-cent jump at the midpoint, and they still expect margins to keep expanding. What's really telling is they're doing all this while also increasing their marketing spend to keep fueling that fire. So here's a crucial point. Management is backing up their words with action. They're increasing the amount of capital they plan to return to shareholders this year up to $1.5 billion through dividends and buybacks. That's a huge vote of confidence in their own plan. All right, let's put these results into the broader investor context, because that's what helps you understand why they matter so much right now. This slide really shows the stark outperformance. I mean, look at this. While the consumer discretionary sector was basically flat over the last year, Tapestry delivered a total return of 95%. They're not just beating the sector, they are in a completely different league right now. Because of all this, this is really being called the proof point quarter. This is the moment where the company's Amplify strategy moved from just being a plan on a slide deck into tangible, structural improvements in margins and cash flow that you can see right on the bottom line. So all of this leads to the most important question for investors now, right? Which is, what's next for Tapestry? Can they keep this up? With the stock already up so significantly, the question everyone is asking is, what's our call on the future? Is there more room to run? Okay, here's our final verdict, and we've structured it as a three-step call. First, our Q3 prediction. We expect this momentum to continue, right in line with management's strong guidance. Second, on price action. Look, the market is now underwriting this raised guidance, so the focus is going to be on sustained execution at Coach and, crucially, seeing those first real signs of stabilization at Kate Spade. And third, that brings us to our final rating. We are signing an outperform rating. This reflects what we see as elite execution, accelerating growth, and a serious commitment to shareholder returns.
And as always, this explainer is for informational purposes only. This is not financial advice.